Hi, colleagues. We are online now.
Hello, everybody. Good morning, good afternoon, good evening. We are starting in 1 minute sharp.
Have your video on? Oh, yes, perfect.
Hello, colleagues in Brussels. Are we ready? Shall we start?
We're ready.
Okay. Hello, colleagues. Good morning, good afternoon, good evening to everybody, to all the participants. We know we have many participants for this side event of the 8th Brussels conference on the Syria conference. And the specific topic of this webinar is on strengthening resilience through innovative and blended financing solutions for the Syrian crisis in the region. So, as you all know, this is one of the largest displacement globally that requires innovative and scalable solutions. UNDP was glad yesterday to co-organize an event, another side event, through the Regional Refugee and Resilience Plan with UNHCR and various CSOs on the future of Syrian refugees in the region. Now, this side event today will zoom into one of the critical aspects in terms of providing solutions in addressing displacement challenges in the region. And this is financing, innovative blended finance, new solutions that need to be brought up at scale. This event is co-organized and hosted by UNDP, the Near East Foundation, and the Abdullah Al Ghurair Foundation. It is held in hybrid format in Brussels and online, and we are connected from the Amman Regional Office of UNDP. Before we start, few housekeeping rules. This side event will be carried out in English only. The event will be recorded. In terms of the structure of the event, we will have welcome and opening remarks from our regional director. Then we will have a panel discussion with the 5 experts with extensive experience in the region. Then there will be selected interventions from the floor, but also open Q&A session. And then eventually we will wrap up. So it will last for 2 hours. We have a packed agenda, but very exciting to discuss a very important topic. For colleagues in Brussels, in the room that join in person, please inform Jonathan from the Near East Foundation if you want to take the floor, or Abdallah from UNDP. Participants will have access to the Q&A chat box. Please feel free to post your question or to raise your hand during the Q&A session. We are pleased to have a diversity of experienced speakers and experts today, including from NGOs, IFIs, philanthropy, from private sector and impact investors. But without further ado, I now have the pleasure to give the floor to Dr. Abdallah Al-Dardari, who is the UN Assistant Secretary General, UNDP Assistant Administrator, and Regional Director for UNDP for the Arab States region. Thank you. Abdallah, over to you.
Thank you very much, Vito. Dear colleagues, co-conveners of this important event, Abdullah Al Ghurair Foundation and Near East Foundation, and all our participants, your participation is much appreciated. I'll try to keep it short. We have 19 people affected by displacement, both refugees, IDPs, and host communities. 19 people affected by the Syrian displacement situation. And those 19 people are actually have been competing for decreasing and shrinking ODA resources, and also shrinking and decreasing humanitarian resources. Funding per se will continue to go down, which makes the whole situation of displacement of Syrian refugees and IDPs an increasingly tense and burdensome situation on the host communities and on all the countries in the region. We need to make sure that we bring in new and innovative ideas into this field. We know that continuing the business as usual, it will not work. We know that we need to change course. We know that we need to bring some innovative ideas and new partnerships. So instead of those communities competing for shrinking funds, ODA funds and humanitarian assistance funds, we need to make them partners in growing private finance and innovative finance portfolios. How can we do this? This is why we are meeting here with all of you today, to listen to you, to hear from you. We know very well as well that we want to make sure that the displaced people are no longer a burden on their host communities and host governments. That can only happen when they are economically active through financing and not by attracting funds and funding that host countries believe should go to their own populations. Host countries have been extremely generous, but we should not abuse their generosity. We should make sure that 19 million people are actually a force for economic empowerment, for innovation, for adding to GDPs in the country, for enhancing fiscal space in those countries, and enhancing the financial flows in those countries for the host communities and for the Syrian displaced. We need to think of innovative financing, blended finance, leveraging, de-risking, new types of microfinance, Islamic finance. All these and others, we would love if this meeting could come up with some basic ideas on how can we take this forward and turn it into a reality. This is not an easy transition. Transitioning from funding to financing is a very complex operation. That's why we brought the best of the best in this room to discuss this subject matter. I'd like you to know that we are, as UNDP and with our partners, UNHCR and others, are thinking of this particular transition from funding to financing in a context of a larger framework, which is the Mashreq Recovery Framework. And that Mashreq Recovery Framework looks at push and pull factors of refugees and IDPs across the region, and that we are designing as we speak the frameworks and the programmatic approaches for those new developments. We need innovative financing. We need innovation in thinking and in proposing some new exciting lines of finance that meet the needs of those 19 million people. They are host communities or displaced Syrians. So I am pleading with you here today that UNDP, as the access to finance agency of the poor, we are not a financial institution, but we are an access to finance institution. We are the institution that can do the de-risking, the blending, the leveraging. We are the institution that can bring UNCDF, our financial arm, to operate within the financial enterprises. We are the organization that can do digital finance and all other innovations. We are the ones who can issue displacement sukuks and other types of debt for refugees and IDPs, investment finance. We know, for example, that there is no credit bureaus that can assess the creditworthiness of a refugee. What can we do about that? Can we use artificial intelligence? Can we use different methods in order to have some sort of a credit assessment of those people? Because we know that you need a credit assessment of some sort if you want to grow in financing. Can we do some sort of insurance? Can we do credit insurance? We are already thinking of takaful to reach 100 million people in the region. How can we make sure that those 19 million are actually part of this program to bring Islamic insurance takaful into their mobile phones, and so on and so forth. So UNDP is committed to work with you. We are the agency that can link between development, policies and technical assistance with financing and innovative financing especially. We work with UNHCR back to back on the question of refugees and IDPs, and with this partnership around the room today with NGOs, microfinance institutions, multinational development banks, and so on and so forth, we would like this event to be a starting point of a process, not an end of the process. The displacement has been there for almost 14 years now, and we want to make sure that if it takes any longer, that it turns into an asset, a growth pole for the region and beyond, not a burden on the region and on beyond the region. Let me stop here. Thank you very much. I just tried to explain to you how important you're gathering here today and how eager we are for our partnerships and eager to listen to you and your suggestions along that long road that we have to take. Thank you very much. Back to you, Vito.
Thank you very much, Dr. Al-Dardari. So now we are moving to the panel of experts. We have more or less 1 hour, and a lot of the solutions and options that Dr. Al-Dardari was talking about will be further analyzed and discussed. We have a panel of 5 experts with extensive experience in the region, and we will be covering aspects related to from philanthropy to refugee impact bond to blended finance to digital finance solution and Islamic finance as well. So I will present the panelists, the 5 panelists we have. Then I will ask two questions for each panelist. Each panelist will have 5 minutes for each question, so a total of 10 minutes for each panelist, so that we can make the conversation active and also give enough time for the final session on Q&A and interventions from the floor. So the panelists we have with us today are Dana Dajani, Senior Vice President, Partnership and Programs, Abdullah Al Ghurair Foundation. Then we have Rabni Yazbek, Senior Vice President of Programs and Impact, Near East Foundation. Justin Sykes, Managing Director of Innovest Advisory. Suraya Zbeih, Financial Sector Consultant from the SIGAP, the consultative group to assist the poor. And Ziad Rifai, Executive Director of Siraj Financial Services. Okay, so let me start with Dana Dajani, the Senior Vice President of Abdullah Al Ghurair Foundation. Hello, Dana. So we know that AGF has adopted a collaborative approach to strengthen the education ecosystem and ensure in particularly that the youth can benefit from that. So the first question I have for you is if you can tell us a bit about what kind of co-financing tools you are adopting, what kind of model you work on. to start with. Thank you.
Sure. Thank you, Vito. So at the foundation, we adopt a strategic philanthropic and a co-financing model, which is, for us, it's a forward-thinking approach that is designed to really maximize impact through collaborative partnerships. I can't emphasize enough on the collaborative part, because we believe that it should be a multi-stakeholder approach, that we include all stakeholders, not only at one stage, but to have it, throughout the process. So we collaborate with governments, with NGOs, private sector, international donors, or philanthropists like ourselves and foundations, our peers. And what we focus on is leveraging each partner's sort of strengths and resources. These partnerships and the collaborations, they end up creating a multiplier effect. And that in turn maximizes the impact. What we believe is that, when you have shared goals, shared interests, rather than duplicating efforts, it's very important for us, and we've seen it in action where we work in harmony, to really look at how we identify what the allowable costs are for each of the donors, as an example, because that way the funding models become strengthened. You complement each other rather than duplicating efforts. Beyond the financial support, which I think is also very important, is we emphasize on the capacity building and technical support. We sort of partner with like-minded organizations, whether for co-financing or implementation, that really involves how you build local capacity, how you mentor and coach, etc. And you ensure that the projects are responding to emerging needs and challenges. Unfortunately, in our region, these are constant, so we can't stick to a plan. We need to really understand that the sort of challenges that are emerging on the ground, our ears need to be there. And what's important is it's not a transaction, it's an organic partnership. So the foundation's efforts are really also on scalability, replicability with other sort of, like-minded donors and philanthropists. And it's all about, the successful ones that we have seen grow are the ones that are localized, and so that the region can really adapt to achieve broader impact. And lastly, one of the things that I'd like to say is that with philanthropies, and I think there is an untapped source, and I feel that we have a lot of our peers that we've been speaking to, and I feel that there's more and more of the philanthropists out there that want to do something. It's a model that, even if a philanthropist has a smaller amount of money and thinks it cannot help, this will help, because it is about engagement and it's about bringing the pooled funding together. So you really do look at bridging the funding gap. And these are growing as well, especially during times of crisis when traditional funding sources may be constrained. So I really look forward to the power of collaboration in creating the meaningful change that we all aspire to.
Thank you very much, Dana. So let's move to the second question, which is, based on your experience so far, what are the possible lessons emerging that you think should be taken into consideration to scale up those collaborations and that you would like to see across the region, particularly on refugee-related issues and to finance their development projects?
Sure. So for us, it's a continuous learning process. Particularly engagement with the field is crucial for us. Our chairman constantly is engaged in the field. He has spoken to his peers, other philanthropists of his level, saying that if you want to be part of this, the first thing you need to do is commitment to engaging in with your partners and on the field and with your staff, basically. So from our different collaborations and engagements, I'll summarize the key lessons learned that really guide our work. First of all, responsiveness and resilience. So we've learned the importance of really supporting our partners and grantees on the ground to meet the emerging needs that I mentioned with the challenges, etc., by repurposing funds and accelerating the decision-making process. So our decision-making process is not as leveled. It is much easier to be able to get the decisions once we have that kind of collaboration on the ground. Also, it's looking at the organic learning process that I mentioned. It's very important to continuously try the new approaches and be open to adjusting based on the real-time needs on the ground. The second part, the second learning is flexibility. Flexibility has allowed us as a foundation to develop innovative solutions with our partners, avoid sort of sticking rigidly to the original plans. They may no longer be relevant anymore. You know, we may have thought of something and then something happens and we really need to work together to create that change. We need to be flexible. So we ensure that there is space for creativity and implementation. This has been crucial in adapting towards changing circumstances. The third sort of key learning is strengthened partnerships. Partnerships, it all stems from building the trust on the ground and building trust with all the collaborators. We've leveraged resources like within our Refugee Education Fund. We had originally planned to support 20,000 young vulnerable young people in Jordan, Lebanon, and refugees in Jordan and Lebanon. We've been able to times that by 5 because of leveraging resources and maximizing this impact. We've learned that philanthropy is about a deeper engagement, listening, sharing expertise, not shying away from sharing the knowledge. This is really to maximize the impact. And we provide our models, our learning, so others don't have to follow the sort of same challenges and mistakes. We believe that strong partnerships, like I said, are built on trust, clear expectations. Open dialogue is very important, and transparency. Lastly, the key learning is realistic expectations without compromising quality. This is something that we have learned, especially not only sort of externally, but also internally dealing with our sort of donor, our philanthropist, the chairman, is that they need to understand the realistic situations on the ground. We don't shy away from speaking with our partners and saying, if there are challenges, we can actually brainstorm together and find solutions. But we can't keep going back and, you know, giving like a nice kind of rosy looking, everything is going fine. We have to fix things. So the open dialogue is important. This openness, it motivates our partners and grantees. What we've seen is that they focus on achieving the results, the outcomes. We're very much outcome driven rather than coming up with promotional success stories only. The success stories that we have is to motivate and empower the young people we serve to be able to get others and unlock other funding, to be able to get other programs, to be able to fix the kinds of solutions on the ground. So we look at, the sort of, the long-standing challenges, but how do you look at them from a different angle? How do you bring other people to look at it innovatively, for example? So these are the kinds of learnings that we've had, and we hope that these kinds of learnings will continue to sort of grow the philanthropic ecosystem alongside all our peers like the UN and the international donors, etc. With us, we hope.
Many thanks to Dana Dajani, Senior Vice President of Abdullah Al Ghurair Foundation. Thank you. I think there are many keywords that we'll be hearing throughout this webinar, very important points that you have raised. Let's move now to Rabia Yazbek, the Senior Vice President of the Near East Foundation. Rabia, basically the Near East Foundation has been working on refugee impact bonds for already a few years in the region. So you have already a wealth of experience. If you can tell us a bit of your experience, the challenges and opportunities that you have seen so far, and besides the refugee impact bonds, other vehicles and instruments you have to use in the region, what can you do in terms of a summary of those challenges, opportunities? What can you tell us? Thank you.
Thank you, Vito. It's a pleasure to be here. So Vito, as you noted, we have launched so far 2 innovative financing vehicles in the region together with industry experts and anchor funders and investors in Jordan and in Syria. And we are now working on 2 new innovative financing vehicles in Morocco and Sudan and South Sudan as well. The Refugee Impact Bond, you noted, is one of them. It's a contract-based financing instrument between 7 actors, including both investors and funders. It's also underpinned by a common framework, as well as payment and outcomes metrics as well. That's the short version of it. We have also launched the first tranche in Jordan. It's been more than 2 years actually, so we've been generating quite a bit of learning. And now we are still fundraising also for the Lebanon tranche for the impact bond as well. So challenges and learning and opportunities. First of all, structuring wise, there was when we started working with our partners on it, it was a little to compare with. So when we were working on it, really the concept of impact bond was still emerging. So the time to launch took us longer than planned. We had also to overcome a lot of regulatory challenges, both at funder level and host community level. Currency mismatch issues, duplications in terms of due diligence among the 7 actors, and contracting, etc. Would we do it again? Yes, but for very specific programs, for very specific contexts. But this has been launched already. It was 2 years of already learning generated. So the positive is that the implementation-wise, it has been better than anticipated. And so far, it's been really very smooth rollout. And the parties who Impact Bond was completely unfamiliar for them are now much more experienced and able to mitigate any potential challenges. Also, what's even more encouraging is now we are seeing program results that are actually delivering better than expected outcomes. For example, I'm pleased to share with you that the return on beneficiary income is ranging between $4 to $10 for every $1 invested as a total investment and total funding over 5 years. And depends how it's calculated, if it's net income or total revenue for refugee and host community run businesses. This is one angle only, and these are all independently verified. And so far, 2 out of 3 cohort have graduated. So it's actually we can say this number with a lot of confidence. Big picture wise, what does this mean? This means that for every $10 million invested, you have generated up to $100 million of revenue generated in local economies. Just referencing also what Dr. Abdullah earlier was referring to around, increasing, contributing to local GDP, to local economies, etc. This is really major. The evidence is still evolving. We will have soon also data on self-reliance and on resilience as well, which we will be sharing. And what's also really very important is that this is proving that it's not just investing in short-term gains. It's also investing in self-reliance. It's investing in resilience. It's invest at the household level, at the individual level, at community level, and also investing in the dignity of displaced affected population, both refugees and host communities. We also have launched also in the Impact Investment Facility in Syria, I noted earlier. So we are seeing also similar trends. So, for example, for every $4, there is $4 return on every $1 invested in terms of financing capital to local entrepreneurs. Main challenge are regulatory void transactions. At the transactions level and at the beneficiaries level, lack of critical infrastructure, lack of financial infrastructure in specific region where this is operating, and complicated sanctions, etc. Were we able to overcome this? Yes, with creativity, with partnerships, with many of you. What's also more encouraging is that those investments are really delivering results better than more stable economies, more than well-resourced systems, and better, enabling infrastructure as well. So the short learning here is that investing in innovative finance or employing innovative finance allows this to happen because it focuses, for example, on outcomes, on results rather than activities. It also provides flexibility. What Dana was referring to earlier on flexibility innovations, these are by design actually embedded into these mechanisms rather than promoted, and allowing those investments to adapt based on changing and complex settings. The Syria experience exemplifies this. Back to you, Peter.
Thank you. Thank you very much, Rabia. The second question is more in terms of ecosystem. So based on your experience with a number of development partners, what kind of shift you would like to see in order to create an enabling environment, so more conducive conditions to adopt innovative financing, being the refugee impact bonds or other innovative financing instruments? If you can tell us in 5 minutes. Thank you.
Thank you, Vito. Important question. So I would classify them into 6 areas. The first one is evidence, strong evidence, invest into evidence. Without evidence, there would be no innovative finance. There are few examples of innovative finance operating in void of evidence, including relying on comparable programs and comparable evidence, but this is really rare. So investing in evidence at industry level, at sector level, is really very critical, and this requires partnerships, horizontal and vertical. Focusing also shifting more the narrative towards outcome-based financing, outcome-based modality. This is critical as well, rather than keep driven by activities and inputs, financing, and all of that. Shifting the narrative towards outcome-based financing, and this requires everybody to adapt to this, not just implementers, not just trade makers, not just philanthropists, etc. Everybody needs to, including humanitarian coordination systems, how we finance these programs. Shifting more towards outcome-based modalities is critical. Also thinking about replication, scalability, in collectively, not individually, and go beyond individual and siloed programs, shorten time to launch, and this would require also for everyone to be a little bit less risk averse, a little bit more willing to share the risks, and developing unifying frameworks, consolidating due diligence, some practical kind of next steps on this. And I want to quote also Dana as well about leveraging catalytic also relief role of philanthropists and philanthropy actor as well as a catalyst. These are at vehicle levels, at program levels. We need focusing on return of investment. This is important. It's important to also think about avoiding cherry picking. Many of the innovative finance also driven by commercial terms. Some of them, so avoiding cherry picking or mitigating them. Graduating those programs into local institution, national programs, and maybe also commercial or market-based also entity is critical, and this require also collective effort. And incubating innovations. Incubating innovations is very critical as well. We need to have we have managed as part of the Refugee Impact Fund to actually embed some level of innovation within these programs. We didn't know that making sure that there is awareness about this, about the ability of innovative finance to incubate innovation, to incubate investment in systems and institutions, etc. This is also critical. And again, going back to my first point, you may argue that all these programs and all programs and traditional financing method should aspire for more innovation, more adaptive management, etc., etc. What I'm here saying is innovative finance is not a replacement, but it's also innovative finance is adding value because by design, it enables those easier than other methods. So let's embrace them. Thank you.
Thank you very much, Rabia. You reinforce many points that Dana mentioned. It's basically you're referring to a mindset shift, in a very one word in a summary, where data baseline collection is important, independent verification, evaluation of the impact itself, the risk appetite that needs to be aligned with the different financing instruments, the whole ecosystem that we were referring to, given the complementarity of different financing instruments. Be innovative or more traditional, they can all contribute towards the same objective. Thank you very much. Let's move now to Justin Sykes, Managing Director of Innovest Advisory. And Justin, in your case, I would like to hear from you, based on your experience, what private sector investment perspective you have been working with, and what attracts their investment decisions in a complex environment like hosting community or refugee setting. If you can tell us, or in more broader terms on crisis setting, if you can tell us a bit of your experience and what are really the attracting factors that you think are complementary to what we have just discussed so far.
Thank you, Vito. And yeah, thank you for the opportunity to speak today. So I think in answer to your question in terms of attracting factors, I think we sort of need to take a step back and understand in pursuit of attracting new forms of capital into humanitarian and development contexts, and particularly these very complex contexts that have been talked about today, we have to recognize that there are certainly different incentives and different rationales for non-traditional actors to come into these deals, and particularly investors who, regardless of the concessionality of the capital they can bring, are still seeking a return on investment. So there are basic parameters that perhaps are different when it comes to these types of actors. And I think that speaks to the blending piece, that blending and blended finance is critical in any of these endeavors, because ultimately, what is the blending doing? The blending is basically to de-risk either actual or perceived risk of a project or an intervention. And when we talk about risk, risk comes in many forms. It could be political risk in terms of sanctions were mentioned earlier. Is there a sanctions regime operating in a country or region? What is the nature of governance in the country which is being invested into? Is there risk of expropriation? Is there functional rule of law? If you put capital, how likely is this capital ever going to come back to you? There is investment risk, which I think is sort of linked in terms of what is the expectation that an investment will hold up against international norms and standards, that you can invest and that money can come back. There is, I think, a real sense of business risk as well. If you're investing in an underlying entity that is a business or a social enterprise producing products and services, how is that entity governed? What is the financial controls with that entity? How strong is the management? And challenges with the strength of the business will affect your ability to generate a return from it. And then I think there's other factors, for example, we've talked about like currency risk. So all of these really are a broad basket of risks that blended finance is and blended finance instruments are seeking to solve. And sort of, different types of blended finance solve or serve to solve those risks. So I think when it comes to political risk, it's then looking at what type of political risk insurance is available, or what form of guarantee structures may serve to attract investors. In terms of capital, what forms of concessional financing, whether that be debt and equity, can be brought to bear that allow a deal that may not be commercially viable at the outset to attract in capital that is right-sized for the stage and growth of an institution, and sort of hybrid forms as well. There's really some very innovative work going on now saying, is debt or equity in the traditional sense the most relevant capital? Or for example, if you're investing into underlying social enterprises, do you invest in a way where you only get a return linked to the actual growth of that business? So sort of royalty-based or revenue-based repayment. If the business isn't successful, you don't get your money back. But if the business is successful, you get it back. And you're not sort of putting a business in debt from the get-go. I think catalytic grants are critical, particularly in fragile contexts, that catalytic grants that could either, for example, take first loss. So investors who are more senior in the deal come in, and that they are protected by a junior investor that is willing to put capital ahead of them. And that capital can be drawn down on before there are any losses to more senior investments. Or recognizing that in certain markets, market rate returns are not feasible for a certain period of time, but investors may only be able to provide capital on the basis of market rate returns. So how can catalytic grants come in and buy down the cost of capital? So ultimately, there is a blended cost that it's one investor will put in 10% and another investor will put in at 0%. And ultimately, the cost of capital to the institution is therefore a blended rate of 5%. And it starts to work for all parties. And then I think the last element around what is attracting blended finance instruments that then attract investors in terms of de-risking is the technical assistance grants that we've seen used in these contexts that can really improve systems, whether it be financial control systems, whether it be impact measurement and management and reporting systems, whether it be management strengthening, so improving the entity's ability to deliver on a project and report on the financial and social impact. Or at the level of the beneficiary, whether it be an entrepreneur or whether it be a farmer who's ultimately being supported for the intervention, looking at business development services, financial literacy. And that support de-risks the investment by, in effect, building stronger, more resilient, more sustainable entrepreneurs. And then I think other forms of TA that we've seen very specifically in the context of Syria is help around designing solutions to the sanctions issue. How do you actually create a window through which financing can occur even within a sanctions environment? And how do you look, for example, at building payment infrastructure and payment rails that allow capital to come into markets where you do not have functioning or you have very nascent financial services? I'll leave it there, Vito, and you can come back on the second question, perhaps.
Thank you, Justin. So again, the importance of the complementary set of solutions that need to be provided, even when we talk about blended finance options that can address different types of risks. My second question is related to your practical experience. If we can give us a few examples of when you worked with other investors, how did you help them navigate the risks and the challenges to make those investments more attractive? Over.
So I think, thank you, Vito. So given the context of today's discussion around the Syrian crisis, I think there's some very practical examples that are in flight right now in relation to the impact investment facility in northern Syria. And I think, there are some very clear barriers to investors. There is strong interest, but there are clear barriers and challenges that need to be addressed. And for them to be addressed, without those being addressed, it creates challenges for that capital to translate from interest on paper to practical dollars in a bank account. So, a number of those are worth sort of talking through. I've sort of mentioned briefly the sanctions situation. And there is some very interesting work that's been done with the entities that are engaged in those sanctions. So the US government, the EU, around creating innovative windows through which investment can happen into this program in northern Syria, in parallel with the sanctions infrastructure in place. I think the nature of the intervention in northern Syria is around providing financial services for micro and small entrepreneurs. That historically has happened in the absence of a regulatory framework for financial services. There is now broader efforts to build a regulatory infrastructure, and again, investors are looking to that regulatory infrastructure, and they want to see the intervention is aligned with that regulatory infrastructure. So a lot of work has been underway, in effect, to turn a program of an INGO into a non-banking financial institution, which is then able to be licensed and regulated by the Financial Services Authority in northern Syria. So again, that gives strong comfort to investors that there is a regulatory infrastructure and that the project is aligned with that infrastructure. I think one of the key issues when it comes to investors is the very nature of an investment. You're putting capital into a project with an expectation, at the very least, that you get that money back. And then there's a sliding spectrum from market rate through to concessional. That requires an entity on the ground that has a products and services model and has clients that are buying a product or service, paying it back, and then generating a return that supports the sustainability of the organization. So investors are extremely keen to see that the entity on the ground has a clear plan for commerciality and sustainability. So again, addressing that is a recognition that a programmatic engagement of an INGO is not set up for commercial long-term commerciality and sustainability. So to solve that, working very closely with the Near East Foundation team has been a sort of long-term view to say, what does success look like? And success is a commercially viable non-banking financial institution on the ground, but that is a legal entity in itself. That's a social enterprise. So work has been done to basically create, to spin off the programmatic activities of the Near East Foundation into a new social enterprise called Siraj Financial Services, which is then structured as a non-banking financial institution to serve the market on the ground. And I think that transition and that journey is extremely important for investors to see. I think another element is going back to this question of business risk. If you're creating a business, who's running that business? How is that business staffed? What are the competencies of the business? What is the governance of that business? Do the management have the capabilities in terms of financial control? So again, another focus has been how do we not only create a new entity that's fit for purpose, but then how is that entity staffed, and making sure that that entity has all of the right components that can lead to long-term commercial success, and investors can see clearly that professionals are being hired, the team is fit for purpose, the key functions in terms of things like audit, financial control are being put in place. And that's you'll hear from later on from Ziad, all of that work is in progress. So I'll leave it there, but that just gives you a sense, I think, of there are multiple barriers, but being able to address these barriers one by one with very practical solutions within a blended finance framework, we are seeing is helping translate investor appetite and investment interest into what we will see is as concrete investor investment into this project. Thank you.
Thank you very much, Justin. What you were referring to also links very well with what Dana was referring to in terms of finance and non-finance support services, particularly when it comes to support to business, investment with local businesses. The two need to be coming together, be complementary to reinforce and have a multiplier effort. This is great to hear your experience on this. So thanks to Justin Sykes, Managing Director in Novesti Advisory. Now let's move to specific aspects related to financial inclusion. Financial inclusion and innovative solutions are part of the same overall solutions that are needed in complex settings like hosting and communities and refugee communities support. So let me turn now to Soraya. Soraya Sbey from SIGAP. Soraya, based on your experience on digital finance, if you can tell us a bit of what has worked well in advancing digital finance solutions in humanitarian setting, and what kind of prerequisite infrastructure would be needed in order to move that agenda forward. Thank you.
Yeah, thank you, Vito. So the enabling environment is critical for financial inclusion because of two mechanisms. So usually the enabling environment will determine the risk and the costs for financial institutions to operate in that jurisdiction, in that region. But the enabling environment will also determine the rights of people and their ability to access these services. So our research shows that the enabling environment usually has two levels: the regulatory framework and then the infrastructure. So if we're talking about the regulatory framework, we're talking about the supervision, the oversight, but also the enforcement of financial regulation. So you might think this is a given, but in fragile context, it can be particularly complex, as some of the other panelists were referring to. So if you think of financial institutions operating in Yemen today, and there are quite a few, and they've been relatively successful, they have two financial sector regulations. They have two central banks, the Central Bank of Sana'a and the Central Bank of Aden, two sets of regulations. And if they operate both in the north and the south of Yemen, it's an added complexity. And I'm not even talking about currencies and exchange rates. And yeah, in terms of regulation itself, one of the key regulation usually is the KYC regulation, or the regulation that gives the identification requirements for account opening. And so one of the factors will be to see if this regulation allows, for example, people with a refugee card to open an account in that country. So that has big implication usually on whether refugees can access to accounts and on the general enabling environment for refugees or for IDPs or displaced people who might have lost their ID. So this is for the regulation. Now, if we look at the infrastructure, so the infrastructure, we usually think about the financial infrastructure. This is the payment system, the data sharing mechanism for credit scoring, etc. And some countries have done particularly well on that aspect. We can cite Jordan, where you have a full interoperability, and this gives more choice to customers for services that are more accessible, more adapted to their needs, maybe closer to where they are. But then in some fragile contexts, it's also a question of physical infrastructure. So connectivity, power, the fact if there are roads in that particular region. So all of this will impact both the costs for financial institutions to operate, the risk they have, obviously, but also the accessibility for customers. Over.
Thank you very much. Thank you, Soraya. So building on that, do you see, and in case how the digital payment in terms of the humanitarian support in a humanitarian context, like transfers and so on and so forth, how they can advance service delivery, key public service delivery, for instance, social protection? Do you see a continuum where from early stage onset of a crisis with these solutions, we can also build a bit of or prepare systemic solutions like those? Thank you.
Yeah, great question, Vito. I would say in fragile settings, we see a beginning of a continuum, right? And so how can humanitarian cash transfers be leveraged to build social protection? Well, there's a big opportunity there because humanitarian cash transfers, it's a huge amount, even if it's declining or in certain regions, but we're talking about $8 billion estimated of humanitarian cash transfers in 2022 for crisis-affected people. And so it's significant amounts, even if humanitarian cash transfers are usually programs that are designed for 6 months or 12 months, actually they often end up lasting more than 5 years. So it's a significant time frame where you can start building something that goes towards social protection. And finally, I would say there has been a strong commitment from humanitarian cash implementers and funders to use social protection rails wherever there exists, even if in practice it remains quite difficult to put in place. So how can this linkage, right, between humanitarian and social protection happen? It can happen through various ways. The easiest way usually is that the humanitarian funding and cash will complement and come in the place of the social protection funding whenever there's a big crisis. So usually systems are overwhelmed for social protection, and then some regions, so I can cite, for example, the twin track in Sahel, where there has been some deep coordination, and you have two tracks, the government track, the humanitarian track. There's coordination about recipients, amounts, and in case of a big crisis that cannot be handled by the government, then it switches to humanitarian, but there's a track that switches back to social protection. And then we see some very interesting initiatives where humanitarian actors or humanitarian funding can help preserve some building blocks of social protection systems. And here again, I'll cite Yemen. So Yemen, most of the humanitarian and social protection funding goes outside of the government. However, some of these programs use a local entity, which is a public entity, Social Fund for Development. And this used to be one of the implementing agencies of the social protection government program, with the thinking that we maintain this block, we keep the capacity, we keep the people, the systems, etc., and then we can hand it back to social protection whenever the crisis finishes. So I see deep linkages, and there's been a lot of efforts to increase linkages. Now, on the ground in fragile countries, we're still facing a lot of challenges to implement them. Thank you, Vito.
Thank you very much, Soraya. So definitely also, I guess, better targeting information systems and digital payments can all contribute to that effect with a multiplier effect across public services in the long term.
Absolutely.
Great. Thank you, Soraya Zbey, Financial Sector Consultant at SIGAP. Now let's move to Ziad Rifai, Executive Director of Siraj Financial Services. So Ziad, Islamic finance has been increasingly important and has been expanding and has been proved to be resilient to shocks over the recent past. So if you can tell us a bit of your insights on how to implement Islamic financial products, insurance, lending, blended finance, de-risking products to support vulnerable populations, that would be already a great start. Thank you.
Thank you, Vito. Thank you for this introduction. Actually, I'm very pleased to be among you today and just to share the experience of the financial institution in general and precisely about Islamic finance. Allow me first just to clarify what is the logic behind the Islamic finance in order to make it sure that we are all on the same page. Actually, it is related to risk-sharing mechanism of providing financial services to displaced or to local communities in general, entrepreneurs in any other any institution or any market or context. The issue that what makes actually Islamic finance resilience actually and built and proven that it's much more resilient than the conventional is that the risk component of providing financial services to entrepreneurs. And this is why if a financial institution are providing conventional finance to an entrepreneur, the risk it will be on the shoulder of the entrepreneur himself if he succeeded or not succeed. So in Sharia compliance products and Islamic finance, usually they share the risk and they share the profit, which means in case of default, there are other mechanisms of sharing the risks, at least from initial point of view or initial steps to share it between the institution and the client. This point that make the sustainability of businesses in economies like this is much more resilience. This is the first point actually regarding that. The other thing is that in the Arab Muslim world, let's say, and especially to the segment where entrepreneurs and micro small entrepreneurs, there are rarely you could find a financial institution that is implementing financial services with Sharia compliance. And that would lead to different reasons, actually, which is the challenges of the source of funds, the funds that are needed to already to implement or to provide entrepreneurs in general with tools and financial services and non-financial services. But anyhow, the demand for Sharia compliance actually product at the level of the micro and small is very high in the Arab Muslim world. And if we want, and especially in the displaced areas, the context that fragile, the context with countries that are not stable, people, immigrants, etc. So especially in our country, the demand gap usually in our areas, it's between 30 to 50% of the potential market. Usually they are not served because they don't have financial accessibility to financial services because they are not according to Sharia compliance or according to Sharia laws and regulation. So I think what we are doing now today is in terms of financial innovative means and tools. And given what has been introduced by my colleague in the session about innovative finance, I think one of the tools in order to make sure that we are targeting and serving the target market that we are in is to listen to them, to be a market driven. And if we just do that, I think my experience in the region, in Jordan and in the region in Yemen, my colleague Soraya mentioned Yemen, Sudan, all these countries, there's a huge demand for Sharia compliance. And it would increase this demand in the areas that has instability, displaced people, they would request more financial services that it's our Sharia compliance. Why we are saying Sharia compliance? With the term of financial services, in term of, let's say, takaful, in term of other means of financial services, should at least to listen to that market, to better understand their need, to develop the financial services that would really meet their needs in order to reach to what? We want to maximize the impact. My colleague mentioned the the impact. And we want to make sure the sustainability of local communities and the institution, the provider, the service provider, the financial institution. And this is why today we are in Siraj. We come to take the brilliant work that has been done by NEF for the last 3 years as a project within Near East Foundation and formalize it in a financial institution that is going to provide financial services according to the market need. We are on stage now to better understand the needs in the North Syria, precisely about the Sharia compliance. We anticipated that the Sharia compliance products are mostly needed in terms of financial services, in terms of financial insurance, in terms of micro insurance, I mean, even saving, investment, etc. So this is what we are trying to do because we are sure from my experience and other experiences, if we want to maximize the impact, improve the outreach, and reach to a high level of financial inclusion, we have to be market-driven first. Second, we have to provide a solution services that enable entrepreneurs, youth, female, to access to finance, which is the outreach that we want to reach to it. So this is in general.
Thank you very much, Ziad. This leads to my next question, actually. If you could give us some practical examples, so since this webinar is about resilience, how innovative and financial solutions can strengthen resilience for refugees and host communities. If you can give us some practical examples through your Islamic finance instrument services provided by Siraj. Thank you.
Yeah, actually, we in general, we are talking about, as I explained in first question, the tools of sharing the risk. And this is the innovative thing that we want to introduce to our client. In Sharia compliance, there are so many financial means. I will focus on the financial services first at this scale, because the takaful, insurance, etc., it's a one mechanism that it will enable everyone to to guarantee everyone. But again, the financial services, especially for displaced communities and population, there's no guarantee. There is no assets accumulation for entrepreneurs. There's no access to financial resources. There's no, let's say, sometimes even financial literacy is an issue. So we are concentrating in both in financial services and non-financial services through different mechanisms. But again, one of the innovatives, let's say, is risk sharing. If we are investing in a micro-level business, there are tools that we could give financial access to finance. We are sharing the profit and risks, let's say, of having this business. And by this way, we are not only generating our profit as an institution on the shoulder of the client, however, we are sharing the risk of having a failure case or a success case. And this is how innovative finance could be a tool that would enhance the entrepreneurship and enhance the ability to sustain businesses on the ground rather than having our, let's say, as a non-bank financial institution, that we guarantee that there's an interest rate and you have to pay back our money and that's it. The Sharia compliance product, it could be like a different case where we share the risk. We have to make sure that our client is going to maximize his profit, to improve his living conditions, and he has a better impact. And this is why we are saying that Sharia compliance in our region, financial instrument, it's perfectly matched the need of the displaced communities because they don't have any acquisitions of assets or even financial access to financial services. But with giving them this opportunity and sharing the risk, it's better even rather than to give it on the client. And this is why we are talking about the funders side. And this is why we are looking for funders who will share the values of getting the risk, not to give it or to make it the responsibility for our entrepreneur. Thank you.
Thank you very much, Ziad. Actually, I'm very impressed, and thanks to all the panelists, because we closed this panel in exactly 1 hour. So we are exactly on time. And now, colleagues who have been connected online have seen the bios of all the panelists. So feel free to consult and reach out to them, given their experience in the region from many different angles that are complementary, as we have seen. So let's now move to the second part of this webinar, which includes basically interventions from the floor and open Q&A. Once again, please raise your hand or post your question in the chat box. My colleague Lana will cluster them if they are similar in terms of the questions and the topic, so that we are more efficient and we get also more reactions from the panelists. But let me start with interventions from the floor. So we have here with us Sasha Gayama, who is the global lead on innovative financing from the Danish Refugee Council. Each one of the interventions are given up to 3 minutes, no more. I will be pretty strict because we need to give the floor for a Q&A as well. So Sasha, over to you.
Thank you. I just unmuted myself. Hello there. So I'm the global lead for innovative financing at the Danish Refugee Council, which is, unlike the sort of government sounding name, is a leading international NGO focused on forced displacement. And one of the initiatives that I currently lead is the Refugee Investment Facility, which is a partnership between the Danish Refugee Council and a Swiss impact investment advisory firm called iGravity. What we've done is that we've collaborated to invest in 2 countries, namely Uganda and in Jordan, for this pilot investment program. We provide what are described as impact-linked loans to SMEs of a certain size, between $100,000 to $500,000, able to absorb that. We provide these impact-linked loans, which I'll get back to explaining what they are, and we combine those loans with technical assistance, which is crucial to enable these enterprises not just to achieve certain outcomes towards refugees and their host communities, but also strengthen them strengthen their capacities from a financial standpoint and an impact measurement standpoint. Impact-linked loans are simply loans for which the interest rate goes down if they achieve on an annual basis certain trackable KPIs that are to do with their ability to shift their business model towards having positive changes towards refugees, whether that means employing or working with refugees or making access to certain goods and services more easy for them, and that will include financial inclusion, etc. We are about to make our first investment in Jordan in a financial institution, and we've done three in Uganda to date. I think, especially given what has been discussed today, one of the successes of this early partnership is we've created between iGravity and ourselves a joint screening process whereby we can jointly due diligence companies where we think the potential impact for refugees and their host communities can be significant. And that is, for me, one of the key takeaways. We need to make these forms of partnerships a lot more easy to achieve. We are present in country on the ground and able to conduct these forms of enhanced due diligence, but also provide technical assistance to the people, the targeted groups. And that is a big part of the DRC's force in this partnership. Finally, what I would say is that we are generously supported by a number of foundations who have allowed us to, on a blended finance basis, attract some impact investment capital, and that's certainly the route that we will continue to pursue as we advance this initiative. The last point I'll make is that we are part of a handful of initiatives that are exploring what is increasingly described as refugee-related investment, so effectively a form of impact investment which focuses on having impact on refugees. And I would direct you, I guess, to the World Bank recent report from the Private Sector for Refugees research program, which highlights some of these initiatives, including the Refugee Investment Facility. Thank you very much.
Thank you, Sasha, from the Danish Refugee Council. Asymmetry of information addressing that bottleneck is crucial. So developing a credit history and doing proper due diligence are critical components in what we have been discussing so far. So there is a room for a lot of cooperation, and we are looking forward to hear from the results of your program in the region, in Jordan in particular, and beyond. Thank you very much. So let me move now on to Alia Farhad. Alia is a manager of Al Majmoua NGO based in Lebanon. I guess many of you know all the work that Al Majmoua has been doing in Lebanon. Alia, over to you.
Thank you. Can you hear me well?
Yes, please go ahead.
So thank you for organizing this very interesting webinar on new innovative financing approach, and happy to see many familiar faces in the panel. So Al Majmoua is the leading microfinance institution in Lebanon. We've been providing access to finance to refugees since 1994. And we started providing loans to Syrian refugees as soon as 2013. And over the years, we have proved that there is a business case for microfinance institutions to provide access to finance for the forcibly displaced population. Now, transitioning from funding to financing is challenging, and indeed it needs a shift in mindset, mainly in bringing the humanitarian and development nexus from theory to practice. And from our side, we think that we need to refer more broadly to financial health of the forcibly displaced rather than only access to finance. And this encompasses things that has been mentioned by Justin and Ziad. It's not only about savings, insurance, but also financial literacy, digital literacy, business development support, and the list goes on. Now, shifting from the pure assistance approach to a more blended finance approach means that we need to have a very good understanding of the refugees. We need to segment them according to their socio-economic profiles and their financial needs, and to adapt the response accordingly. refugees are not a homogeneous group, and they need very different type of financial and non-financial services. So from our experience, we've seen that some need a graduation approach that blends cash assistance and access to finance. Some are looking to access debt, while some refugee-led established SMEs are ready to access more innovative financial products. So here comes the importance of having this holistic approach and a multi-stakeholders approach that Dana was mentioning earlier. I mean, humanitarian actors, development actors, and investors have to talk more with each other so that we can develop and implement those innovative financial solutions. Last point I would like to say is, having said that, we cannot disregard the specifics of each host neighboring country. So this includes the economic situation of the host country, the enabling regulatory environment to provide access to finance to the refugees. In Lebanon, for example, we have a strong pushback from the government if the host community is not part of the equation. And last point is that we're facing some increasing challenge with the compliance requirement, the anti-money laundering, the financing terrorism, and specifically from traditional investors when MFIs, so when microfinance or other actors are looking for loan capital to be lent on to refugees. I think it's important that we sensitize the investors also on adopting some more realistic requirements so that we can operate properly on the ground. Thank you very much.
Thank you very much, Alia. Really, we agree 100%. And actually, very often, the innovative part of financing is on the how rather than new instruments. Again, trying to address asymmetry of information, trying to manage risk, having a proper balanced risk and appetite, and also trying to be implementable and looking at the impact of both communities, the refugees and the host community. So your profiling, segmentation are lesson learned that we have very much well in mind. Thank you. So let me move on with Serena Guarnaschelli, who is a finance expert at COIS. COIS is an innovative finance firm. Serena, over to you.
Hi, can you hear me well?
Yes, very much.
Excellent. First of all, it's a pleasure to be able to contribute to this discussion. I was just hoping I could be in person in Brussels, where we have an office, but sorry, I couldn't make it. As a way of an introduction, so I work in the world of innovating finance, impact investing, and blended finance for almost 20 years. I also set up an organization called Convergence, the matchmaking blended finance, to make more and more areas in the social environmental space investable by using blended finance. COIS as a firm is an impact finance firm. We do two things. We manage impact investing funds ourselves. We have about $500 million invested across a diverse set of products. I sit on the advisory side, where we focus on structuring innovative finance products and partnership. And I had the pleasure to work with NEF and Rabia specifically on launching the Refugee Impact Bond. So my contribution will be a bit of a personal one. I just wanted to share how we came onto this journey and how we view instruments like the Refugee Impact Bond to play a role to help bridge financing for the humanitarian space. So as a company, we always start with a problem we would like to solve. For us, migration and refugees in particular has always been a topic close to our hearts for personal reasons between myself and other team members. And we had done work on migration and first-time refugees in Belgium. And when we looked at the problem itself, we found that actually particularly for the Syrian crisis, most of the refugees were sitting in the region. So we embarked on a study that looked at how can we look at sustainable livelihoods for refugees that are in the neighboring countries of Syria. And the problem we wanted to solve was one where, as already pointed out by many, humanitarian funding is scarce, is limited. It's focused on the nature of the first phases of the crisis, but a lot of these crises are protracted. So we found there was a mismatch sometimes between the funding and the nature of the crisis. And as a result, the inability to think about or to really solve for resilience as part of this funding. We also look at skilling and other forms of programs that are funded typically by donors. And we were perhaps not surprised, but we found the majority of funders knew quite well about, for example, the cost of trainings, but had less clarity or less confidence about attributing to, for example, sustainable jobs or any other forms of resilience to the money, to the programs that they funded. And so this brought us to the second step in our process, which was, what is the product that can help us solve this problem, right? So one is the mismatch, and the second one is the lack of evidence and lack of focus on outcomes, particularly resilience. This is where we come up with the idea of an impact bond. It solves for some of these. It's not the only instrument, by the way, but it solved some of these challenges, and it had an additional bonus that it was an investable product. So for us, the important features of the products, Rabia already spoke about. The most important one is the flexibility and the innovation. For us, it was the fact that it was multi-year, that it allowed our partner NEF to actually look at results over a longer period of time rather than short-term annual outcomes and outputs. And in fact, when you think about the program that has been deployed, looking at these outcomes perhaps a year after the training has been deployed is key to actually assess what Rabia was saying, the resilience and the other effects of that training. The second one is evidence building. So again, answering the need for donors to actually, with limited money, to pay for what they care for, which is outcomes. This is one of the best instruments in terms of alignment. It's also one of the most complex ones, but it's one where the payments are triggered when outcomes are achieved. And as a result, provide a relatively rigorous, perhaps more rigorous than traditional programs, evidence at the outcomes level. And the last one, which is for the investors, this is where the investors play a key role in pre-financing the program. And for us, it was important to bring a product that could create an investment opportunity for some of our investors. One is a private fund called FIRD, and the other one is the US Development Finance Bank, DFC. And the DFC, for example, was looking for a product in this space. And as we know, there are not many. So these allow them to actually invest in a topic and in a sector that is very much unaddressed from an investment perspective. And the last step for us.
Thank you. Please wrap up.
Can I just say one thing?
Yeah, very quickly.
Just partnership. Yeah, the last P is partnership. This would not have happened without NEF and their track record.
Yes, as we made it clear from the very start, that's an important key word to transform and make an ecosystem conducive for this set of solutions that are needed. Thank you very much. So the next one in line is Nabil Kasraoui from FinDev Advisory. Nabil, over to you.
Good morning, everybody. Thank you for the invitation. I'm Nabil Kasraoui, CEO of FinDev Advisory. We are specializing in the theme of financial inclusion and impact investing, and we are working with MFIs in fragile countries in the fundraising and in the impact measurement of the fund they receive from the donors. So I want to highlight some point very important that was discussed during this webinar. Currently, we are working on Sudan and in Niger and in other fragile countries, and we informed that there is the huge cost of funding, and conjugated with the hyperinflation rate and the hyper depreciation of the local with dollars, local currency with dollars. This is the case of Sudan. So with an interest rate of 40%, maybe the microfinancial inclusion could not achieve the profitability. So in this case, blended finance solution can be a good and innovative product in refinancement for MFIs with a grant to finance technical assistance facility specific to cooperative association to financial literacy for farmer, best practice in agriculture, and financial inclusion also for this particular financing. At the same time, the blended finance must contain a component of loan, but not a loan with 25% like currently the case in Sudan, but concessional loans in terms of maturity, in terms of grace period, as well as in terms of tariffication, maybe with zero cost or with interest rate not very important. All this point of the blended finance product will mitigate the cost of funding for the MFI to facilitate at the end the possibility to provide loan for cooperatives or loan for farmer with affordable price. I'm following currently the situation in Sudan, and I know that financing activities are halted during this period because of the hyperinflation. So I think that the donors and the representative of the investor today can collaborate together to facilitate this issue. Thank you very much.
Thank you very much, Mr. Nabil. Now let me give the floor to my colleague Funda Suzer from UNDP, from the Istanbul Center for Private Sector Development. Funda, 3 minutes.
Can you hear me? Yes, all right, it's working. Great, thank you so much, Vito, for giving the floor to me, and thank you for this very informative and thought-provoking session. I would like to start by providing a couple of insights regarding what UNDP has been doing in order to attract investments to the developing countries and crisis context countries, and also help countries explore to the innovative finance instruments. UNDP is actually working on 2 levels. The first level is for de-risking. And for de-risking, we can talk about the policy de-risking, but also closing data and information gap for potential investors in several countries. One of the concrete tools that we use for this is the SDG investor maps. With SDG investor maps, we actually identify specific investment opportunities in several countries, and we collect data and information around those specific investment opportunities to present to the investors. And the data and information that we collect includes information on the financial environment in the country, incentives around the investment opportunity, the partners that the investor would potentially engage with, and also the economic indicators in terms of the ticket size, the investment time frame, the IRR, etc. Additionally, we also help countries to develop project pipelines for investment as well. So this with these tools, we actually help countries to de-risk the potential investments. Additionally, we conduct impact investing ecosystem analysis, through which we evaluate the potential opportunities and challenges in several countries for impact investors. And also we identify the policy gaps that the government can intervene in and take steps and measures to improve the ecosystem in the country. And the second level that UNDP works on is actually helping countries to design innovative financing mechanisms, such as the resilience bonds or the social impact bonds or development impact bonds, and the impact funds. Before I conclude my remarks, I would like to also pose a question to the speakers, particularly to Rabi. So it is important to replicate these the successful implementations of innovative financing instruments in different countries. So my question is, what are the critical factors when it comes to replicating these tools and mechanisms in different countries, particularly in crisis context countries? Thank you. Over to you, Vito.
Thank you, Funda. So we will continue with the final intervention, and then there are a few Q&A, and Rabia will have a chance to reply. Thank you very much. So the last intervention we have on our list is Tarek Akel. Tarek Akel has been CEO of a number of banks here in Jordan, and now works also with us on banking and finance. Tarek, over to you.
Hello, good afternoon all. Thank you very much for giving me the floor, Vito and colleagues, and this is a very enriching discussion. I want to talk about something a bit more mundane in these discussions, which is the mechanics of incorporating a refugee population into an existing system. And this is what we had to innovate around in Jordan on several occasions. Typically, if you have refugees coming in from a country into a neighboring country with an established and stable banking system, there are certain rules and conditions for actually benefiting from the banking products and benefiting from the services that come from banking, starting from opening an account all the way to getting financing. These conditions have to be worked around, basically, in order to allow the refugee population to benefit from these services. Case in point was when Syrian refugees started flowing into Jordan. The rules of the Central Bank of Jordan would not allow people, the refugees who are in Jordan, not under any sort of residency program, to open bank accounts. And a lot of the refugees did not have documents, not left without their passports or any papers that prove their identity. So the workaround was to actually utilize biometric scanning, and basically in coordination between a Jordanian bank and UNHCR at the border crossing where refugees were coming, retinal scans were taken, and then these retinal scans were used by the bank to identify the refugees as who they claim to be, and then the aid, the payments coming from UNHCR would flow through this bank, through the bank network, whether it's branches or ATM machines, using retinal scan again to identify the beneficiary. That is actually an approach that was used by other banks as well. It created a bit of an issue because refugees typically congregate in large numbers in certain areas that tended to overwhelm the bank infrastructure in that area. So the bank had to separate the machines for the refugees from the machines for the non-refugees in order to maintain the same level of service for its clients. I remember I was a board member of the bank. The bank is Cairo Amman Bank, and the Jordanians on the call would know what I'm talking about. In Irbid, there were machines that said not for refugees, and that actually created a lot of issues for people who felt discrimination to a certain extent. But that was a means to try to accommodate a large number of refugees onto systems that were not prepared for that volume of business. Things as mundane as if someone who had allergies, when their allergies flared up, their eyes were not clear, so they could not withdraw money from their account if their eyes were red, because the retinal scan would be different. But the important part of this, the important lesson of this is, we have managed, or the Central Bank of Jordan, in cooperation with the banks, have managed to create payment without having a bank account. We had sub-accounts under a single account for UNHCR. UNHCR fronted for the risk of the identity of the beneficiaries. There were limits on the amounts that can flow, and they could not, no banking services per se were available. It was just transactional sort of distribution of the funds coming in from UNHCR to the refugees. And then subsequently, some payment systems were added to that, where we had captive points of sale at certain supermarkets, certain shops where the refugees can use their cards that the bank issued later on to actually withdraw money from, instead of withdrawing money to actually do purchases. So the point of the story here is innovation is needed sometimes to deal with the central bank requirements, with the prudential rules, to accommodate the needs of a population, especially if this population is coming into a system that's already stable, already well established and running. This doesn't cover the situation where you have displaced population within a country or refugees into a crisis country. This is the case where in Jordan we had a stable system and we had the refugees added, and we had to find a way to accommodate these refugees in terms of the banking services, not the finance services. So this is just the dealing with funds flowing over.
Thank you very much, Tarek, for sharing that experience that reinforced that innovation can be very much in the modalities that we implement some of our work. Jordan also has a Jomo Pay, advanced digital payment system, which is very interoperable with many other payments. So that's also a model to look into. So I will give the floor to my colleague Lana, who can brief us on some of the questions from the floor. We are perfectly on time, so Lana, over.
Thank you very much. So it's a colleague called Gunnar Welsholz who is asking 2 questions on microfinance in fragile settings. The first one is, to what extent is group-based lending a suitable approach for risk management? And the second one, what are the enforcement mechanisms that could be applied in case of loan delinquency in an environment where the regulatory framework is weak? There's also one more question that just came in from Inam Khan. So I'm just going to try and rephrase it or paraphrase it a bit. The colleague is saying it would be interesting to hear about insurance schemes, how blended finance can work, and also sector-specific considerations when it comes to social cohesion as well amongst host and refugee communities. And how do you also align with host government preferences and priorities?
Did they specify to whom they want to address the question, or was it?
None of them specified. Yeah.
Okay, so we go back to the panelists who wants to take the 2 questions. And Rabi, in your case, there is also an additional question from our colleague Funda. Panelists?
I can take the first one around group-based modality, and then how to manage delinquencies in a fragile context. I think the group-based model is an interesting one. I think it absolutely can serve the purpose described, particularly in an environment where there is no ability to generate collateral, or in an environment where typically without collateral, microfinance institutions require a personal guarantor. But in a conflict situation, the ability to access a personal guarantor is very limited. So the group modality can work in terms of mutual guarantees, but I think we have seen it works in certain cultures and not in other cultures. We tried it in Somalia, and it has not worked very effectively because it's very entrepreneurial and individualistic culture where people actually don't want to guarantee each other. They want their own loans for their own purpose. So it really depends on the culture. And then I think the second part around how do you manage loan delinquencies in a environment where there is limited enforceability. Again, I think there's a lot of experience in this. And it comes down, I think the ability to go to courts or the ability to use formal processes is extremely limited. And if it is possible, it's extremely expensive as well. So I think it really comes down to community norms about recognizing that if somebody is not repaying a loan, that is one less loan that can go back out to the community to help other people in need. So I think a community sort of messaging to the community that repayment is linked to others' ability to have finance, But in the case of there being legitimate circumstances, having tools at your disposal that can manage that, for example, loan rescheduling, or having an emergency loan facility that can kick in the event of material factors, like a drought, for example, affecting crop production. So having these, and then the other thing I've seen and Soraya will know from a Yemen context, that they have been historically very successful in launching micro takaful products. So you could get a loan for $300, or you could get a loan for $315, and the 15 additional was a micro insurance that in the event of disability, a workplace injury that meant you could not carry on with your business activity, or in the event of death, basically your family did not take on the obligation of repayment, the insurance covered that. And we've seen that's very successful because in the event of these activities happening, there's almost always 100% default rate on these loans. So this reduced the default rate very significantly.
Thank you very much. Ziad, over to you.
Yeah, actually, I would like to add a comment and to confirm what Justin has just mentioned about the microfinance and the group lending methodology. Actually, the group lending methodology was a perfect mechanism, let's say, in the early stages of the industry. However, now we can see in everywhere, not only in displaced communities or fragile countries, everywhere the group methodology is diminishing in a way or another. Because I think individualism, it's an issue with entrepreneurs now. So this is why I think I want to confirm that. And from my experience, that even in Sharia compliance or conventional industry, usually group lending methodology doesn't work. However, there are some new alternatives actually that would replace the group lending methodology, credit scoring, AI, etc. There are so many tools, credit bureau, loan guarantee, that would cover the risks that usually we used to get loan group lending methodology to replace. However, there are now a new other mechanism like even credit insurance in the introduction has been mentioned. Now there is loan guarantee and credit insurance that would replace that thing. Regarding the penalties and delinquency, actually, and this is again back to the norms of the industry, which is the social pressure. I know that there is no enforceability in most of the countries now, even in Jordan. There are some new regulation that would forbidden taking action, legal action for small loans or small balances, and not only in Jordan, the Arab, most of the countries in the world. So there are other mechanisms of having to make sure the paying on time, starting from incentives to the client. And this is what I believe, and from experience, that if we provided the clients with incentives to commit themselves to pay, then I think that would work, in addition to the social pressure that we could use in terms of collection. But again, the other point, which is related to delinquency and not commenting on, I think there are also a mechanism like insurance, loan guarantee, that would also share the risks of such a client, because clients, why they don't pay, either they don't feel the pressure, they don't feel that there's enforceability, or they have a serious case of illness, sickness, death, etc. So if there's availability of microinsurance or loan guarantee or credit risk to cover those things, I think it's not become an issue anymore. Thank you.
Yes, thank you, Ziad. Goes back to providing the package of solutions that can be complementary. That's really critical. Rabia, do you want to respond to the questions, the last two or any of the two, and to Funda's question? Over.
Thanks, Vito. Yes, so on the group-based model, there's not much to add there. We've had first-hand experience in this, and the results have been actually going in the same direction. There is less appetite, there is a less interest, especially also mobility in urban setting and peri-urban settings. there is less interest in these modalities, and there is less social capital as well. And at the same time, like Ziad mentioned, there are ways to actually better ways now to address the reasons why group-based model were introduced at the first hand, using new technology, etc. And there is also there is argument around a group-based model undermining entrepreneurial also drive. The second point regarding insurance, so we've introduced also first-hand experience in this. We've introduced de-risking products in the context of de-risking products of lending programs. One of the products we put together very rapidly was after the tragic earthquake in northwest Syria and Turkey, where we deployed a tailored product and in the form of emergency loans. It has worked. It has worked actually beautifully and successfully. We have a learning paper that has been published recently as well. I'm happy to share this. And there's very important lessons that has been generated by this experience around, not only around de-risking products and emergency loans, but also in terms of market-based responses and what we like to call them localization plus agenda, and how you leverage actually market actors for delivery of these innovative mechanisms. So these are just two rapid examples, first using first-hand experience in the region. On the really very important point around replication. First of all, I think we need to be specific regarding which instrument we're talking about, because each instrument has a specific parameters and specifications. So the development impact bond that we noted, it's actually multi-country instrument. It covers both Jordan and Lebanon. So it's by design replicable in that sense. However, also impact bonds, what's beautiful about them, they're outcome-based financing mechanisms. So they're driven by shared outcomes, and outcomes, especially when it comes to high level, like imagine development impact bonds is driven by survival of productive activities. So this can be employment, this can be business, this can be and anything between, agricultural activity, etc. And it's also another one which is related to basically ability for people to meet basic needs. And it's rooted in the consumption metrics which governments actually use. Also, it's underpinning social protection, also programming and ability to people to graduate from aid dependency into self-reliance. So the application is really, so the same mechanism can be deployed in this refugee context, displacement settings, but also in social protection programming. I'm trying to give you an example about replicability also and transferability all of the modality itself. Not everything can be copy and pasted, but there is a lot of replicability potential there. The second instrument as well we're working on, which is in the context of Sudan and South Sudan, there is also significant potential for replication there with very rapid tailoring or the deployment or multi-country also programming. One beautiful aspect of this, which we didn't talk much about, is also aligned with life financing agenda, which also at intersection with also the localization agenda, and how you devolve funding to be managed and owned and run by these communities. What does this mean is that in terms of shocks and resilience, this is the ultimate objective of resilience, to have community in control of basically funding, where they can be rapidly deployed into if there are shocks and from floods to man-made disasters to etc. So That's a few examples. Let me pause here, but yes, the replicability and potential is that either by devising in multi-country, multi-region platforms and frameworks, or by replicating some of these models through rapid tailoring in other contexts as well.
Thank you very much. Thank you, Rabia. It seems we have another question, Lana.
Yes, another question from Miguel Garcia Bermejo. Could you please elaborate what type of de-risking MFIs and other FI are most requested for incentivizing them in on-lending to refugees and host communities?
If I may volunteer, Ziad, for this, I think this is good.
Yes. Yeah. Thank you. Actually, I think I've mentioned during my intervention, the previous one, what are the tools that would help. Actually, the financial institution, in order to incentivize financial institution and to work in this field, is to give guarantee funds. Actually, that will remove the pressure over the institution from pressuring the clients themselves. This is one. And using other alternative to manage proactively the risks. Because we know that in credit, there is no bad client. We know that there is a bad loan, which means that the proper procedure in order to screen the clients and the businesses ahead of giving them the loans is the proper way of managing the risks, in addition to the availability of other funds, like guarantee fund. This is from my side.
Thank you, Ziad.
Sorry, just to add to Vito, I would agree with Ziad's statement that there is, no such thing as a bad client. It's all about bad loans. Then I think for financial institutions who are seeking to more intentionally target displaced populations, I think it's about helping them build knowledge and understanding of the market. What is unique about a displaced person in terms of their assets, their capabilities, and their needs, and how does the loan product or the services of the institution need therefore to be tailored to those specific circumstances and needs. So I think technical assistance around product design and how an outreach and marketing and how to communicate with a new client cohort and understand them goes a long way to then de-risk the interaction with the client.
Thank you very much, Justin. Let me ask Soraya if she has any final thoughts. We are perfectly on time. Soraya?
Thank you, Vito. No, I would just add around the group lending that, yes, this is something that is very common in most fragile countries, so not only in settings with refugees and IDPs, but generally with poor people. It is a tool that has been very much successful. Now, the path to bringing them to something around individual loans is slightly less clear. But yeah, thank you. That would be my only element.
Thank you. Thank you, Soraya. So unless any of the panelists have some final considerations, pressing final considerations, I will give the floor then to Caroline Vernet, who is the director of the Near East Foundation for the European Union, for some closing remarks. Caroline, over to you.
Thank you very much, Vito. Esteemed colleagues, Your Excellencies, ladies and gentlemen, on behalf of the host, UNDP, the Near East Foundation, AGF, I want to thank you all for participating today. I want to thank our 5 panelists, our moderator, Vito, all of you who made very key contributions to this discussion, all our audience, both here in Brussels, that could come in person as well as online, and as well as to all the many colleagues who supported in the organization of this side event. We're represented by a diverse group in the room and across the world. We have governments, UN agencies, the private sector, INGOs, IFIs, and others. These actors have shown deep commitment to support those impacted by protracted crises. However, while there exists long-standing desire to collaborate more deeply and excitement about the prospect of innovative financing, as we've seen, it's often a challenge to find scalable ways to work together. So from today's discussion, we know that there is a lot of work to be done. We've also heard from many panelists that a mind shift is needed. But there are major opportunities to design, invest, and implement new scalable financing instruments in the region, which can crowd in private sector funding in a way that we haven't seen yet in the region. According to Convergence data, the Middle East and North Africa region only accounts for 8% of blended finance transactions globally, compared to 47% in Sub-Saharan Africa and 15% in South Asia. The challenge before us is significant, both in terms of the needs of refugees, as well as their host communities and the massive funding gap. But the opportunity is also great. So Dana mentioned at the beginning of this side event, the power of collaboration. Let us join forces going forward to find new financial instruments and vehicles that can complement. We also talked a lot about complementarity, complement current efforts and resources towards a more sustainable and innovative response. Therefore, today, in front of you, with you, we want to call for an alliance building towards a practical joint programming. We want to move together to develop new solutions. Please reach out to us should you want to be part of the team of this joint work. Once again, I would like to thank you all, our co-host, UNDP, AGF, and thank you, all of you, and wish you a nice rest of your day.
Thank you. Thank you very much, Caroline. Colleagues, you have seen we have just basically scratched the surface. There is so much to talk about. Remittance, we haven't touched the remittance cost. If we could lower remittance cost and shift them from consumption towards more investment that benefit both host communities and the refugee and displaced communities. We haven't talked credit history. If we could be portable using innovative instrument, blockchain, so that wherever displaced go, they also have those portable set of information to lower the transaction cost, and risk appetite and diversification and incentives that are put in the right perspective with the right risk appetite are critical. So we just touched the surface, and it's important we continue this discussion on our side, and I'm sure on our colleagues, partners. This is just the start. We want to make this a really changing, transformative kind of discussion, and bring up to an ecosystem level where there is, on one side, flexible instruments, managing expectations, but also impact, measurable material impact rather than output and activities at the project level in the traditional way. With that, I thank you very much. This is just the first event. You will hear more from us. Thank you.
Thank you. Thank you, everyone. Bye.